Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for September 2016. Now, in the last couple of months, as we've moved deeper into the third quarter of the year, we've seen quite a steep decline in crude tanker rates, especially on the mid-size segments, the Aframax and the Suezmax, where in August we saw rates drop below $10,000 per day, and on some routes they were in the low single digits, which is sub-OPEX levels. And these are obviously very weak rates we haven't seen for a couple of years. And some of that is due to normal seasonality. We would always expect that Q3, especially August and into September, would be the weakest part of the year, because that's when the refiners reduce their purchasing of crude when they go into maintenance. But there have been some other factors which have pushed tanker rates down during the third quarter of this year relative to the past couple of years. The first of those is that fleet growth has been accelerating during the course of this year. If we look at crude tankers of Aframax size and above, deliveries in 2015 averaged about 1 million deadweight per month, whereas in this year that's doubled to about 2 million deadweight of tanker deliveries per month. And in recent months, that's got even rate of deliveries has accelerated even more. For example, in the Suezmax sector, in the first 4 months of the year, we only saw 2 deliveries, whereas since May there have been 10 Suezmaxes enter the fleet. So we are starting to see the impact of that high order book, which we knew was coming, now starting to be felt in tanker rates. But there have also been some things on the oil side as well that have impacted the tanker market. Firstly, looking at oil production, in 2014 and 2015, we had a couple of years of very strong oil supply growth. Global oil production increased by 2 to 3% in those years. This year, global oil supply has been very flat. But within that, we've seen some regions increase their production and some regions decrease. We've seen an increase in production from the Middle East, especially with the return of Iran after sanctions. In fact, Iranian production is pretty much back to where they were before the sanctions were put in place. We've also seen higher volumes out of Iraq and Saudi Arabia. But where we've seen the productions fall is mainly in the Atlantic basin, in North America, Latin America, but especially in West Africa. And in Nigeria, we've seen as much as 800,000 barrels a day of oil supply offline this summer, which is the equivalent of 20 fewer Suezmax cargoes per month. So it has quite an impact on the mid-sized tanker market. And that reduction in Atlantic oil production, it doesn't just have an impact on volumes, it also has an impact on the distance as well. One of the big drivers of crude rates and crude tanker demand over the past 3 or 4 years has been this excess supply of crude in the Atlantic moving to Asia, into China and into India. Whereas in the last 2 or 3 months, because of the supply outages in the Atlantic, we've seen that supply of crude going long haul to the east has fallen. In fact, in June and July, the amount of Atlantic crude going to India and China was about 1.5 million barrels a day lower than it was in the first quarter of the year. So you've got a reduction in Atlantic volumes, and then that's had the knock-on effect of reduced voyage distances as well. So it has a dampening effect on ton miles. Looking at the oil demand side as well, we have seen lower demand from refiners in the last couple of months, very low levels of refinery throughput. As I said earlier, some of that is seasonal. You would expect refinery throughput to be lower right now because of maintenance, but some of it is structural in that global inventories of both crude but also of refined products are at very high levels, and so there's less incentive for the refiners to run the refineries at very high throughput levels, and so that's had a bit of an impact on the demand side. And then finally, some things that helped the tanker market earlier in the year, such as congestion at ports in China and at loading in Basra in Iraq. A lot of that congestion has now cleared, and that's obviously freed up tonnage to then be on the spot market competing for cargoes. So again, that's been a negative for the mid-sized tanker market. In the last week or two, we have just started to see rates turn around a little bit, and that's positive as we start to look towards the Q4 and the winter market. We do expect that rates will recover through the winter, that they will move above $10,000 a day and come back with normal seasonality. And that's something we would expect every year as you get higher demand in the winter months, as refiners start to increase throughput again, and due to winter weather delays. As you get later into the year, daylight hours get shorter, weather conditions worsen, and you get an increase in vessel delays. And that usually really kicks in November, and then certainly into December and January, which are typically the strongest months of the year. We also think there could be some upside from some returning production in Nigeria. As I said, about 800,000 barrels a day of production has been offline in Nigeria. But just in this last week, we've seen that the force majeure on Bonny Light exports has been lifted. And we expect that the force majeure on Focados crude will get lifted later this month as well. So we should see some more West African cargoes, which is going to help Suezmaxes and Aframaxes in the Atlantic, and perhaps also kick up some ton-mile demand if some of that crude heads east into China and India. So we do expect a stronger winter market, but as we look into 2017, the tanker market certainly faces a lot of challenges, not least of which is another year of very high fleet growth in 2017. The tanker fleet will probably grow by between about 5.5% and 6% next year, but in subsegments that could be even higher. For example, on the Suezmax side, we think that the fleet growth could be as high as 7 to 8%. So it's a lot of ships that the market has to absorb next year at a time when the oil markets could be in a period of rebalancing. With oil prices remaining relatively low, we don't think that oil production will grow much next year either. And that means that if demand does grow, then the refiners are going to have to source that crude increasingly from inventories rather than from imports. And that's going to put a dampener on demand at a time, as I said, that the fleet is growing. So we do expect 2017 to be a challenging year. The silver lining to all this is we do think that that could be a relatively short-lived downturn. And if we cast our eyes further ahead now, looking at 2018, actually the order book comes off quite quickly again. And the encouraging thing is that there's really no orders, or very few orders have been placed in the last 6 to 12 months. And so we're pretty confident now that the 2018 delivery schedule for tankers is going to be fairly low. And if the oil markets have gone through a period of rebalancing in 2017, by 2018 it might get to the point where oil prices have recovered sufficiently that it will kickstart some production again and lead to another increase in cargoes and ton miles. So we do think that we're in kind of a 2-year up, 2-year down kind of cycle rather than a 5-year up, 5-year down sort of super cycle like we saw between 2004 and 2013. So while it is going to be a challenging year in 2017, we do see some green shoots ahead as we look towards 2018. So that's our tanker market update for September, and we'll talk to you again next month.